Welcome to our analysis. By the end of this video, you will grasp why Japan's bond market is sending a warning signal not seen in 3 decades, and how the yen's stubbornness near 162 poses a threat to global equity and crypto markets. Despite rumors of intervention, the US dollar to Japanese yen has surged back to levels that keep the financial world on high alert. We are witnessing an unprecedented rise in bond yields that could lead to a significant liquidity shift. So, why is this news making waves across every trading desk? We are navigating uncharted waters. The US dollar to Japanese yen has recently hit 40-year highs, and this situation transcends mere currency weakness. It signals a widening gap between the Bank of Japan and the global landscape. After decades of ultra-easy monetary policy, the BOJ is finally taking steps that could impact trillions in global carry trades. The market is testing Japanese authorities like never before. The numbers are shocking. The 10-year Japanese government bond yield has soared to 2.83%, marking its highest point in nearly 30 years. This increase comes as the Bank of Japan indicates further tightening, with interest rates now at 1%, the highest since 1995. On top of that, the BOJ is scaling back its bond purchases. This shift has ignited a massive sell-off, with foreign investors dumping Japanese bonds at the highest rate seen in 3 years. The era of cheap yen liquidity is swiftly coming to an end. On social media, the market's response has been nothing short of intense. Analysts are labeling the yen's weakness as the biggest threat to global markets. Despite speculation of intervention last week, traders observed that the US dollar to Japanese yen rebounded almost immediately back to 162. There's a palpable tension in the air, as market sentiment is torn between fear of a crash and the urge to maintain carry trades while yields remain favorable. Financial institutions are raising alarms about a risk that extends beyond the yen's price, the unwind. For years, investors have borrowed yen at low rates to invest in high-risk assets, including US tech stocks and cryptocurrencies. As JGB yields climb and the BOJ tightens, this strategy becomes increasingly costly. A sharp drop in US dollar to Japanese yen, whether through intervention or policy changes, could trigger a forced liquidation of these global assets. Experts warn that the gradual reduction of yen liquidity could unleash severe volatility in US markets. The effects within Japan are complex. While a weak yen bolsters major exporters by increasing the value of their overseas earnings, it simultaneously raises concerns about imported inflation for the broader economy. The surge in bond yields reinforces the hawkish stance of the Bank of Japan, which could ultimately raise domestic borrowing costs, benefiting financial sectors that thrive on higher interest rates. The yen serves as the heartbeat of global risk appetite. A stable, weak yen typically fuels market rallies, but we are witnessing a distinct shift. The rising volatility alongside increasing yields is creating a direct connection between US dollar to Japanese yen fluctuations and global risk assets. If the Ministry of Finance intervenes effectively, a sudden strengthening of the yen could lead to a disorderly unwind, jeopardizing not only stocks but also the stability of emerging markets that depend on the global dollar-yen liquidity pool. For individual investors, prioritizing risk management is crucial. Keep a close eye on talk of intervention. Official statements often precede sharp currency reversals. Monitor the 2.83% level on the 10-year JGB yield. If it continues to climb, anticipate more foreign selling and potential turbulence in equity markets. Be prepared for sudden spikes in FX volatility that could liquidate leveraged positions in moments. Diversifying away from pure carry trades may prove wise as policy normalization accelerates. Looking to the future, our AI analysis outlines 3 possible scenarios. In our base case, yen weakness lingers near 160 to 162 until the BOJ confirms another rate hike, resulting in periodic but limited interventions. In a more optimistic scenario, a quicker-than-expected slowdown of JGB purchases could push yields above 3% and force the US dollar to Japanese yen back toward 150 rapidly. Conversely, if the Fed maintains its hawkish stance while the BOJ is too slow to react, the yen could break past 165, making a massive, multi-trillion yen intervention nearly unavoidable. Each path carries significant volatility risks for crypto and global equities. In summary, we see that JGB yields are at a 30-year high of 2.83%, the BOJ is tightening policy toward 1%, and the risk of intervention for US dollar to Japanese yen remains at critical levels. The era of easy carry trades is facing serious threats. If you found this deep dive insightful, please subscribe and leave a comment below. How are you protecting your portfolio from yen volatility? Thank you for joining us, and see you in the next analysis.